how does the Fed affect markets? This is a conversation that comes up every once in a while, especially around FOMC meetings. We had one just here recently. The Fed hiked 75 basis points. Interest rates moved lower on the actual hike day, causing a lot of people to be like, man, what's going on? I thought the Fed, when they move rates, that causes rate markets to move in the same direction. Generally, yes, but let's get into some of the nuance and what the Fed actually affects here. Now, the Fed directly affects the Fed funds rate, which can then affect longer term rates. The Fed funds rate is a very short term rate. It's very specific around its use of bank to bank lending and everything else. But the way that it affects other interest rates and then how those interest rates then go on to affect stock markets and those stocks can affect everything else. The sentiment of the stock market can affect volatility markets, can affect, currency markets and everything else. Let's start here at the source, which is to say the Fed funds rate is a really good benchmark for short-term interest rates. And so when the Fed comes out and they say, hey, we're hiking the Fed funds rate by 75 basis points or 0.75%, you're going to see the biggest influence in shorter term Treasury rates or, whatever rate that you're looking at, but primarily people across the globe are trading US Treasuries. And that influence is going to also seep into 10-year and 30-year rates, but to a lesser extent, the further you get away from the current just short-term rate. And that makes sense, right? If I said to you, the Fed, they only move, 50-year rates, you would expect movement from the Fed to affect 30-year rates more than 10-year rates, more than 2, and so on down the line. And so the Fed affects directly the Fed funds rate. That's a short-term interest rate benchmark here in the US. And that is going to influence most directly 2 years and then 5 years and then 10 years and 30 years with a diminishing effect. And I want to show kind of that direct relationship and then get into some of the longer term interest rate products and their movement recently. So here are the Fed funds futures. It's a really interesting market, not traded a lot, not really a big trading product for everyday people, but the ZQ futures, traditional interest rate markets like ZQ futures will be priced whereby the interest rate is 100 minus the price of the product. So recently, ZQ dropped down to 96.5. 100 minus 96.5 gives you a Fed funds rate of about 3.5%. And so this is where the futures for 2022 are projecting rates by the end of 2022. And so you might say, hey, Frank, the Fed just hiked 75 basis points, and now they're up to, I think it's about 150 basis points or 1.5%. This thing is saying 3.5%. Well, keep in mind, and this is essential to trading interest rates and to everything that we're talking about today, futures price in the moves before they happen. You'd see the futures markets around interest rates were going haywire 2 weeks ago and last week, leading into the FOMC's event. And then when the Fed actually hiked, interest rate markets actually moved lower because the futures had already priced it in. Good example here that for 2022, the Fed funds futures right now are priced at 3.5%. They're saying that's where we think right now in June, in summertime 2022, where short-term rates will be at the end of the year. And there's going to be a lot of movement around this. If they think, oh, actually, the Fed's not going to hike as much, these Fed fund futures are going to move up, the interest rate is going to move lower, and vice versa. If they, we need to hike a lot, these futures will continue lower, and the projection of interest rates by the end of the year of Fed funds interest rates, that is, will be closer to 3.75, 4%, what have you. And you can see this falls in line really closely, but not exactly, with that 2-year yield. Close direct relationship, as direct as you can get in a trading product, getting up to close to 3.5%, but actually a shade under it. The futures are currently trading at for that 2-year. And you'll see that Treasury futures move with the Fed funds and what the Fed is expected to do, but with some bigger swings around it. And I want to show you the other markets here leading up to the Fed rate hike day and then on the day itself, you can see that the biggest mover was the 2-year leading up to that event. And then the biggest mover after they hiked to the downside here was the 2-year. And this just shows you a little bit what I mean by what I say, the Fed funds, what the Fed does to that rate really affects the short-term interest rate market, and it affects the longer-term one, but by a diminishing effect. You see here, the 30-year moved higher by almost just half the amount of the 2-year leading up to the rate hike. And then the day that it happens and some of the interest rate markets are giving back a little bit, Fed Chair Powell came out and he said, we're going to hike for sure, but we're not going to hike maybe as much as you think. The short-term interest rate market really came off, and the longer-term one, it came off, but not by nearly as much. And so this speaks to, one, the direct effect that Fed funds rates have on short-term rates and less direct on long-term rates. And two, that on the Fed rate hike day, they hike by 75 basis points and rates move lower because they're pricing in the next move. And that's what I want to leave you all off with, is the trade now is not what happened at the June FOMC. It's maybe not even what's going to happen at the July. What's going to happen next from the Fed? And you're seeing for 2022, just like those futures that I showed you, the CME's FedWatch tool showing you 350 basis points or 3.5% is right around where we're projecting the Fed to be. The trade now, do you think that it's going to be higher than 3.5%? Well, then you can buy this S2Y future, a very small, practical, everyday trader kind of market to be trading. If you think that this is too much of a projection and they're actually going to land closer to 3% or 2.5% or what have you, then you can go in and sell this S2Y future. And so there's, the full story of how the Fed affects Fed funds rates, how those rates affect Treasury rates and everything of differing durations further on down the line, and how you can trade those markets. The trade isn't what's now, friends. It's coming up next. And now coming up next is Splash Into Futures. I'm going to get out of here. Hopefully you had some fun talking interest rates and what the Fed's going to do in the near and medium term. If you have any questions, you can always reach out, but stay tuned for Splash Into Futures. It's going to be a good one. I'll see you all tomorrow. Peace.